Hello, welcome back to WinFS Trading YouTube channel, the only channel that has been optimized to make you rich trading the Forex synthetic market. In today's video, I'm gonna show you the power of moving average, how to turn $1 into $1 million plus using EMA Loop Orientation. Okay, this topic gonna change the way you perceive market, because actually when you trade, when you run technical analysis, most time you still lose, most time you see a lot of errors. Is because you could not modulate your price action with the EMA or moving average. Okay, in this content, or in this video, we shall be discussing about EMA. Even though the simple moving average is very important, the EMA is much more important, because average traders are just day traders, or a kind of uh, medium term traders. So because 80% of traders are day trader or medium term trader, meaning that their trades last from few hours to few days, we shall consider EMA, because that is very very powerful to analyzing such type of trading. Why the simple moving average is for long-term trader like position traders, the EMA is for short-term or medium-term traders. Okay, so we shall be discussing more of EMA than the simple moving average. Okay, but when it becomes so important, then you can switch to simple moving average. You can actually use the simple moving average in place of exponential moving average once you understand your price action and your time frame of analysis is actually a higher time frame, because the moving average actually become useful and more accurate if they are used at higher time frame like H1, H4, daily and weekly. Okay, even M13 and M15 can still be reasonable, but at M1 and M5 they tend to have some errors. Okay, so this is very necessary, and I need to read these notes so that you can flow with me when I go over to the MT5 chart. Moving averages, MA summary from first principle. The first principle is very necessary, because that will give you the foundation of what moving average is. A moving average is a technical analytical tool. This is tool. Okay, is a technical analytical tool used to analyze financial markets or other time series data. It is calculated by taking the average of closing price. Here we only consider both SMA and EMA. Okay, the difference between SMA and EMA is that SMA is unweighted, meaning that they are calculated using the actual price, while EMA are weighted, meaning that the actual price is actually shifted either higher or lower in order to fit what is happening currently in the market. Okay, the SMA look long term while the EMA look short term, meaning that the EMA is more sensitive to price, like it can generate as much signal as you can, like it can generate signal at early period, like it can generate signal so fast that the SMA will do. Okay, moving average data points are calculated from natural data points of measurement or events. So there is a shift of any difference between an MA value and natural mean data point. Okay, at higher periods, number of time for which data prices are are collected. Are you getting this? At higher periods, the higher periods means number of time for which data prices are collected. The MA serve as a low pass filter, meaning that if the time frame is if the period you choose is high, such as 200, such as 300, such as 500 periods, the MA will now serve as a low pass filter. Then what does it mean to be a low pass filter? Because this is a kind of ideology, but it does happen. It means that even though in electrical engineering we have filters, a kind of stuff they use in designing circuit, but that is not what I'm talking about. We are talking about mathematical something that influence how price behave. So here it means that it will filter short-term changes in the market and give you the long-term trend of the asset. Okay, so that's a very good, powerful advantage of a trader who is actually making use of these two. MA lags and are useless in a regime or Asian section of the market. So for you to actually apply the MA, you should actually understand the price action. Make sure the market is trending at higher time frame. If it does that, if it is actually trending at higher time frame, then the moving average will work. And if not, it's not going to work. Okay. Major issue here is how to modulate the MA with actual price action in order to generate profitable signal, and that is the next work I'm going to do on the MT5. How do we actually generate signal from the moving average? But before I continue, know this: whether simple or exponential moving average or other type of moving averages, because there are other types like linear weighted moving average and all of that. Any of them you are using, they are lagging. The reason why they are lagging is because they are calculated from the actual price, and most time the actual price that are being used are weighted, meaning that they place certain importance on some prices and the value go up or go down. So there will be shifts in the signal provided by the moving average and the one provided by the price action. So the moving average signal and the price action signal will always be out of phase. Like they are likely going to be out of phase 60 to 70% of the time. In other words, you don't need to trust moving average signals, but you have to modulate it with the price action. If they are saying the same thing, that means they are not in phase, and when they are in phase, that is resonant, and when that is resonant, there is maximum profit. Okay, so that is it. Let's continue with this. Okay, this is a synthetic market, and this is volatility 50 YS. Okay, you see, if you want to actually select moving average, you are coming to this tab, or you are coming to this. You see where they write something like sign off. You click on it, so it will bring you. You see the main chart, and then you will see on that trend. You will see moving average. When you click on it, this is where you type the period. This is where you type the shift. The shift is zero for, based on my own way of trading. Zero is the best. So the method is exponential, because I have said it already. We shall be talking about more of exponential because we are day traders, or kind of medium, short-term medium traders. So exponential is going to benefit us. But if we are a positional trader, then you change over to simple, and you are going to get the exact same result. You are going to get the same result. Okay, so we have style, and we have the time frame. You cannot change. If you go to time frame, just make it all. Okay, you can't just select some, let it appear in all the time frame, so that any time frame you are, you can understand the market. Okay, so that is it. So I have three moving averages here with different colors. I have black moving average, the blue moving average, and the red moving average. Okay, so each of these have different period. This is period 200. Okay, so that is the truth is, the bigger the period, the larger the period of a moving average, the the lower the the lower the sensitivity of that moving average, and then the greater the accuracy of that moving average. When I say accuracy, like the greater the um, trend characteristic of that moving average. A large period moving average will actually represent the trend very accurately than a short term, than a short period moving average. Okay, but it will be less sensitive to uh, price reactions. It will be less sensitive to reactions, or to input output behavior of the market. So when I say input output, I mean impulse and retracement. You can see that the short moving averages, which are the red and the blue. This red is 50 period, and this blue is 100. That is the short. I'm sorry, that is differences in period. This is period 50, period 100. You see that whenever retracement come to 100, it output an impulse. Whenever retracement come to 100, or the come to 50, I'm sorry, whenever retracement come to 50, it output an impulse. Or whenever retracement come to either 50 or 100, it outputs an impulse. But it is hardly reacting to the black. But what the black is doing is that it will form a parallelism between this red and blue, and then hold price, so that price will restrict themselves inside this red and blue or outside the red and blue. Anytime price start trading against the red and blue, it means that the trend is about to change, and you should be careful about that. Okay, so when you come here and start checking these things, you know that I'm saying the truth. This is the 200, and this is the 100, and this is the 50. Okay, every other setting are the same. Okay, so the problem now is, how do we generate signal given these trend moving averages? Okay, how do we actually make use of these to generate signal? You see, this should not be used alone. You should apply common price action. It's not even common, because price action is not something common. Like, we can say that moving average is common, but price action is very, very necessary and important, because if you are wrong in price action, the indicator will actually give you false signal. You lose more money because they are lagging. Okay, that could be a kind of crossing like this. Suddenly it will change, and you're buying in this condition, you lose more money. To change and start selling, and your stop loss will hit. Okay, so how do we actually do this? You divide your screen into two parts. Okay, divide your screen into two parts, or you have two separate devices, a laptop or phone, or two phones, or two laptops, something like that. Make sure both are connected to internet. So you go to your you have to run your of the analysis first. So this is a volatility. Let's start with the volatility 51s. So in the monthly time frame, we see that this market is on a bearish mode. Is a bear market, and the markets have been moving impulsively. When we pull our fib 2 and we start from where it we actually connect one of the fib 2 end to where the price started. So we actually know that one day price will have to come here. Is a sure stuff. Price have to come here. The price have to test 23.6 or 38.2 or even 50, and then continue going down, because you actually apply Fibonacci when the market is impulsive. Impulsive means that, like, when the market is impulsive, like, it moves without creating some retracement in that given time frame. Like, it doesn't create enough retracement. Like, it is very serious moving in a given direction with no much retracement. Okay, with little or zero retracement, that is impulsiveness. Okay, so though there is this definition of trend, impulse and retracement, and I don't mean that impulse is normally when the direction in the direction that converges with the main trend is an impulse. Okay, but when we say impulsive, it means that the market is moving in a given direction with no much retracement, and that is when you apply Fibonacci to see when you are going to continue in the direction of those impulsiveness. Okay, or the impulsive movement. Okay, so uh, here the market is basically selling, and we are seeing some sort of retracement in the month because of this hammer, that to be a hammer. Okay, created here. So when we go to the weekly, we notice see that is actually, after it have created a small uh buy event, a small retracement, it start going down again. Then we go to daily. And daily is showing us that this market uh, currently break this level, And you see what I'm doing, I'm running price action analysis, break this level. But today we have a fake breakout on this side, so the market is tending to close below this structure. If it close below this structure, then it's going down. But if it close above this structure, there is likelihood it will come back to test this resistance zone. Okay, and then from there, you know that you should be buying in that case. Okay, so that is it. So in the H4, we notice that it has already broken this higher time frame structural level and is coming to test it, and we actually have this trend line. Okay, I'm just running my top down analysis. We actually have this trend line that was also broken, and we also have this another trend line making this plane a negative plane. But since price is trading outside this negative plane, there's likelihood that if we have enough breakouts that maybe reach somewhere here and come back, then we are going to continue going up. Okay, so at least for now, the market is going up, but at this point, it could change direction to come down. But if we're able, because this is hash 4, so it's very, very powerful. So if we're able to understand this event, that there is high probability that price will go up from this lower trend line, then you should have know that it's more reasonable than to actually sell at this lower trend line. So every time price hit this lower trend line, it creates some sort of buy signal. Not actually strong, but because the plane is pointing downwards, so it's not strong. But it was strong if we are monitoring it in this way. I will have this, so we can take it to be strong because the plane is actually in the direction of the main trend. Yes, like the polarity or the slope of this plane is positive, and the trend is also positive. This is a plane positive, trend positive. So if you are buying here on the lower plane, you are succeeding more than someone that is actually selling. But look at what happened here. This plane have changed. This is positive, negative. So if you are selling here, you will not be stronger because selling is negative and the plane is negative. But if you are buying, is less strong because imagine you buy here. If you have been taken out somewhere here, okay, um that's good, but that does not prevent me from buying at this lower trend line. So if I buy at this lower trend line, I'm reasonable than selling. So that is the logic. So how would I have actually entered this event that happened here? How would I have traded it and make some profit, at least take profit on this upper trend line? Because I know that this market actually generated, depending on where you enter, is generated close to 6,000 plus pips near the upper trend line. So I will now switch over to the um, indicator setup. What am I looking for? What am I really looking for? Okay, you see, the condition, I may not write it down, but you have to write it down. That's why if you're watching my videos, you have to watch to the end. Those that have quitted in the middle have lost it all, right? So what you need here is for this thing to work perfectly. When price is coming to saturation, look for double bottom. You need a double bottom to exist in the time frame of entry. So the entry time frame, depending on the strength of that signal in the higher time frame, you know that the buy is weak. I hope you know. So if the signal is tending to be weak in the higher time frame, then make sure you use 5 minutes time frame for entry. But if it's very strong in the higher time frame, then use 15 minutes or use 15 minutes or 30 minutes time frame for entry. The reason why you are not going to be using 1 minute time frame for entry is because it have a lot of noise and the lagging effect will be very, very large, that you lose more money. Okay, because sometimes market is not ready to move in a given direction. It will just create a false direction and change direction. Are you getting it? So if the signal is very strong at higher time frame, like when we are doing your top-down analysis, if what your mind is telling you that the signal is very, very strong, then what you need to do is to use M15 or M30 for entry. But if it is very, very weak, but you know that surely it must happen and you are going to get some profit, you have to use M5 for entry. At least, not at least, at most, not M1. Don't use M1, use M5, so that you by using M5 you will filter errors, you will filter false signal out, and then you will actually trade the right signal. Okay, so look at what is happening here. The first condition is crossing of the three moving average. So the first two cross, but this one didn't cross. The trade didn't cross. So the first two moving averages, like two moving averages, keep crossing, but the three moving average could not cross. That is a very big indication that the market is what, ranging. It's not ready to cross. And finally, we succeeded crossing here. So immediately you notice a cross, because this is a weak signal. So I'm standing on the 5 minutes time frame to get this signal. Immediately it crossed. I cannot enter this market because it crossed. No. Look at what I'm going to do. I want to get my signal providers. Are you getting me? The signal provider are like there are usually two moving averages. The red and black are signal provider, but the red is highly sensitive signal provider, while the black is low sensitive signal provider. Both of them are very important. Black is low sensitive does not mean it doesn't produce signal. It produces signal, but it is the red that will make that signal stronger. Are you getting me? Now the blue line, the blue moving average, which is 100, is range absorber, or is a risk management controller, because most time price will come and react to it. Both blue and black are risk management controller. Most time price will just come and react to this blue and black, and so the blue serve two purposes. It absorbs range in the market, and it also provides signal. It serves three purposes. It also provides signal, and it helps you to position your SL relative to the black. But basically the black help in risk management, and the black help in doing what? Knowing the trend direction. The red and the blue cannot provide the trend direction. Like, they can provide direction, but they can provide interest, but they can provide direction. So what's the essence of trading when you don't know the direction? So the black is very, very important here. Okay, so what you need is a market is buying because the direction of this course is upwards. And what I mean by upwards is that if you are following this market from behind, or if you are following this market in the past and you are waiting for it to cross, as it is crossing, you notice that a tangent drawn to the point of crossing, the slope of that tangent is positive, so it's going up. Now, because it's going up, you cannot enter this market because you see a cross. You need this black moving average to be to be below all the two moving average. Like, this black moving average have to be below the red and blue moving average. That's the first condition. That means it have to envelope, like it have to, I don't know, it have to support the moving average 50 and 100, which are red and blue. It have to support it, and the only way it can support it is to be below it, because a support supposed to be something under, and it will hang it up, and then both of them should not touch each other. They should be parallel, like approximately parallel, even though it is not parallel in resistance, but approximately parallel. If they are touching each other, it means the signal is weak, so you have to wait for it to be separated. I cannot actually at equal distance from each other, but at least there should be a fine separation. So when this thing happen, then make sure the blue line is in the middle, because it's a range absorber and also control the risk. And then whenever price come and touch the red moving average, that is the time you are going to enter, because it is now the signal provider. So it have to touch it and then rebound. It have to touch it and bounce up off. If it touch it and break the red, you are not going to enter that trade. You are going to wait. Like here, it break, it touch it here and create liquidity below the red. You have to monitor for this. You have to run breakout tests. So the red, you have to run it on the red because that is the high sensitive signal provider. So what you need to do is, if there is a small liquidity sweep below above the red, can be above or below depending on the signal type you are looking for, you are going to wait for the price to come up on the red, like to start trading. This is a buy signal, so you have to wait for price to start trading above the red. Once that happens, don't mind whatever is going to happen next. Your stop loss should be just about the black. There is no way, they have already created that liquidity. Once they enter here and leave, they have created the liquidity. They can't create it twice. So even if there is false signal, they will not react to the black. So when your stop loss is about the black, then you are still in the trade. So right here, the entry should have been here. You enter here. When you enter here, the red is providing the signal because you see, as price reacts, it didn't break it, but it started shooting up. So you enter on that bounce off. When you enter here, your stop loss, how do you place your stop loss? You don't just place your stop loss outside the black moving average, because when you do that, it's not reasonable. Because if you do that, you see that there is no technicalities inside this. You are just gazing. Yes, we know that price will respect the black. Price will not violate the black once the direction is defined by the black. If the black define upwards, price will not just come and be creating liquidity about the black. Anytime it does that, it means the trend is about to change. So what you need to do is make sure you actually follow this thing as early as possible, so that you will always place your stop loss about the point of intersection of the crossing. But if in any case the signal was very strong in the higher time frame and you are not able to enter this market when the crossing happen, just use the black moving average as a guide. You can just place your stop loss as outside it. It will protect, because price always respect this. This video is taking time, but it's worth it. So we are going to actually check a signal that is very very strong at higher time frame, and we are going to actually do something reasonable about this. um let's consider crash 300 index, okay? And let's go to the technical chart, because this is an indicator chart. So here we're going to open cash 300. After, I'll go to Forex market and start with the month. Okay, so let's assume that this event has not happened. Okay, this event has not happened. Okay, so how, like, in how many ways should we have generated this signal that actually produce around basically over 3,000 pips? Like, in how many ways should we have done this? Actually, this market created a base here and break out of this base. I call it a base, and then we expect, because the breaking was impulsive. Maybe in the weekly you notice that well, expect my price to come and react it, but it couldn't react to this base. So in the, you see, it couldn't come and react. The price keep pushing down and all of that. And so we can now say that sellers are in control, right? So that's good. So if you even go further to daily, we see the footprint of sellers trying to do something. Like, there are some levels that price can never reach while going up, and then it suddenly collapse, creating lower low. That is, sellers are very very strong, and this was a kind of this ranging or consolidation period, but sellers are very very stronger than buyers, or like not even stronger. They basically have equal hands, but it's more reasonable to trade in the direction of the selling or in the direction of the sellers than buyers, because this is a kind of, they tend to create something like this, a triangle that needed to be broken, and that's what happened. Okay, like once this triangle is broken, the selling pressure increases, and that's what happened. um so we have understood the price action. So what we need is to go to indicator, because the strength is very very strong in the higher time frame. I'm going to be taking my trade in the 30 minutes or 15 minutes. So I want this time frame of the this time frame of entry. The bigger this time frame of entry, the more you escape some of these errors that will come up. The error that can lead to a stop loss hunt, the error that can actually make you lose that trade when we deserve to win that trade. So, but the thing is that if the time frame of entry is a little bit higher, you might miss the signal entirely. So be moderate, 15 or 30 minutes. So I prefer 15 so that I will get high risk reward, because the lower the time frame of entry, the bigger the risk reward. Okay, so here I'm waiting for this crossing to happen, but I'm not going to enter yet. I don't care about what people are saying about it, but I don't care about the pressure or emotion that are making me to say, I'm going to miss out. And then this black have to come up. See, we are looking for self signal. So black and red are signal provider, while the blue are range absorber and risk management controller. Now, this black have to be above for selling to be reasonable, right? So, and then the red have to be high sensitive signal provider. So when price is coming towards it and suddenly start rejecting, and you are within the vicinity of this crossing, you are actually entering this asset. You're actually placing your stop loss about the crossing. If you meet it too early, like when it's just break one structure like this one, yes, if it have only just one structure breaking, you can still work out your stop loss about it there. Okay, so you enter here, stop loss here, or you miss this structural breaking and then you break this one. All you need now is to enter this market when it comes to the red, so that red will provide the signal. If you notice there is no liquidity sweep and red start providing the signal, you are entering this market and your stop will be outside the black, and you should have gotten this. Okay, so much wasting of time, because this video is getting longer and I have to be fast here. Let's just select one example on the forex markets. We assume that there is no news, because whenever there is news or fundamental release in the forex markets, you see that the indicator does not work again. Yeah, they don't work again. That is fact. So we assume there is no news. Okay. So I'm going to work on um I'm going to work on growth because it's very lucrative. I'm going to work on growth. There's no news. We are like today. As I'm launching this video today, we have CPI. So it's quite crazy. So I can't just use the most recent candlestick formations here. So I have to go back in the past. So let's go to the technical chart. Okay. So we do something. We do something reasonable. Okay. So here we are opening goods on the technical chart, and then from the monthly, start from the monthly, and after run the analysis, the price action analysis, you notice that we have this level. Price always came here and reject, came here and reject. So it is a sign that there is high probability. Most people neglect top down analysis. I don't know why, but you have to understand what I'm doing here. Okay. Okay, so we have that these 2 points are reacting, or you can even make it more realistic. Okay, line of best fit here. So there is probability that price will just, I don't know how it will happen, but price will just drop to here by algorithm. Based on the algorithmic nature of market, price can just drop there. But that is what is really happening here. Okay, so sellers are in control, right? Even though the plan is positive, yeah, it's uptrend, but sellers are in control. The buyers are just dead for now. So we go to the weekly. we notice what sellers have been doing here. They recently break this. Yeah, they break here. But before then, they have already there was a tiny structure here, because if I use the body, you know that that body is something that is more uh, critical to look into. Price, they break it and retest it, and then we have a new break here. Okay, the price is pushing down. So gold is going to hit 1911 or even 18 series. It's possible. Okay. Um, you see, we also have this thing that happens here. That we have a internal trend line. You just need 2 points to get a trend line right, and then the price just break it and retest it in the week, and it's pushing down. Okay, so we have the daily. Clearly, you see that it is it is changing from the uptrend to the downtrend somehow, but all we need is for price to take out this turning point. once Once price take out this turning point, we expect goods to start trading below um 19 1970. Okay, 1970. So sellers are in control, right? Simple. So I don't need to go to hedge fund. All I know is that sellers are in control. But if I go further to hedge fund, you know that sellers are really in control. If goods manage to take out this turning point, sellers will be fully in control. But if gold fails to take out this turning point, then it will be trading between, yes, and like we have that's what we call trading range. So we will be trading between here and here. What is a trading range? A trading range is if there is a breakout, so the high that leads to that the trend that leads to that breakout, and the saturation point of that breakout is the trading range. So there is a high here that leads to breakout. So the trading range is between this high and whatever low that will be created. And then that low will be created when price actually stop going down and coming back to this structure. Not necessarily coming to test this previous swing, but at least near it. And so we will now be saying trading range is that we should be expect to trade between here and whatever the low is, and that will model our take profit and stop losses as well. Okay, that's good. Uh, you know, so in how many ways should we have sold goods? You know, apart from the fact that as of like few hours ago the CPI was released before I start doing this video. I'm sorry, after I started this video, the CPI was released. So I'm not going to be considering the session of the charts during the CPI, because the indicator doesn't work when there is news or when the market is ranging. So what I'm going to do now is I will consider those region of charts that have no news. So let's go to the indicator chart and start working this thing. Okay, so this is good. I'm not going to consider good all the way from here to here, because couldn't is the news, right? So we are not going to consider that. So right here I'm going to be, because the signal is strong in the higher time frame, so I'm going to use M30. Why I want to use M30 is to filter errors. So what I need is, I'm just looking for a downward crossing. Yeah, I've seen one here. So we have a downward crossing here. Okay, there's a downward crossing here. Not necessarily waiting for a retest. I'm just looking for suppression between the three moving average. So there is a separation here, right? So we have a separation. So next thing is to wait for price to come to us here. As price is coming to us here, after the crossing, there is a separation. Then as price, and then you see the separation. Then the black moving average should be above. We are looking for sell, right? As well as we have seen in the higher time frame, and the blue have to be in the middle, and the red have to be providing signal at the lower boundary. So here we have price coming to us here, somewhere here. So we can enter here, even though it doesn't touch the red, but at least we can enter here. That's the fact, you see. And we should have got this move from here to here, even though it's very small, but at least, you see, indicator lags. So when you are using them to get signals, know that you are going to miss a lot of signal, right? That's why I can further go to 15 minutes so that I can actually see the signal as early as possible. So we should have entered somewhere here. It's not a matter of retest, it's a matter of conditions. So this black have to be above, the red have to, the blue have to be middle, the red have to be ready to provide signal without break and like a liquidity sweep. So we have this coming here. So we should have entered here. SL above the cross, about the crossing. These around the 80 pips or 8 pips, depending on how you calculate your pips. Then we should have generated over 200 pips or 20 pips, depending on how you calculate your pips. You can see everything is working as I have been saying in this video. I'll be ending this video. This is 40 minutes above, 40 minutes plus. Why I make the video longer is because it has a lot of information which I cannot just explain in just few minutes. Try to actually help yourself. When you watch video, you get motivated, but don't throw it away. Join our courses, enroll for our courses so that you become an expert. Join our VIP signal channel so that your life become more better and better. You leverage the effort. You leverage the effort of others for you to go fair. So you really need to do something about your trading, okay? And we are here to serve you the best. Thank you and bye for now.